Hello and welcome to the Morningstar series Why Should I Invest With You? I'm Emma Wall and I'm joined today by Ned from Old Mutual to talk about gold and silver. Hi Ned.
Good morning, Emma.
So the first question is, why is the gold price not higher considering the significant political turmoil we've faced over the last year?
Well, my first answer to that would be to point out to you that gold in sterling is actually doing very well, particularly after what happened with Brexit a year ago. Obviously, sterling weakened, and so the sterling gold price, in fact, is near its all-time highs. Investors always look at gold in dollars, but unless they're actually situated in the US, that's probably not the right thing to do. So gold is doing okay, but it is also important to say that gold doesn't move based on geopolitics. So you might think a bomb would go off and gold would go up, but actually gold moves on the basis of real interest rates or real yields. So that's the relationship between inflation and interest rates. If you're losing money holding cash, gold will go up. Or if you think you're gaining purchasing power holding cash, gold will go down. And that's really what moves the price.
And so then interest rate rises, as we saw in the UK last week, and as we're expecting to see in the US in December, that sort of thing should have an effect on the gold price.
It absolutely will always have an effect on the gold price, but it's, again, always about the relationship. So if we think inflation is going faster than expected, and we think interest rates are going slower than expected, then gold will absolutely go up, and vice versa. So it's the relationship between both those things. That's what drives gold up and drives gold down. But I do think gold should be in all portfolios anyway, because it has a very obvious decorrelating effect on portfolios, which is something people are looking for.
And looking at US dollar terms, although we are situated in London, the gold price is around 1,200 and something. It was 1,800 and something in 2011, 12, 13. Can you, as an investor, expect to see those kind of prices again?
Well, in my view, undoubtedly yes, and even more so with silver. In fact, if you look at gold and silver on an inflation-adjusted basis over a very long time frame, you're going to find there's nothing else you can buy which is trading at a fraction of where they were 30, 40 years ago on an inflation-adjusted basis. Really, these are absolutely counter-cyclical hedge assets. Now, you may not have needed to own them for 40 or 50 years, but I'll tell you that cyclically, this is a moment where you do need portfolio insurance, and so you're just getting it at a much cheaper price than you might otherwise have had 3 or 4 years ago.
And of course, there are several ways to invest in gold. One is to invest in the commodity itself. Another one is to invest in the equities that are exposed to that. Where do you see, as a fund manager, the opportunities in gold and silver at the moment? Yeah,
so you want to buy the gold and silver mining equities if momentum is moving towards the metals. So if money's coming in, they're going to provide a geared effect. So a fund like the one that I manage will deliver you somewhere in the order of a 2 to 4 times the underlying gold price effect. What that means, in my view, is you can hold a smaller allocation at portfolio level and deliver a much more meaningful outcome. Whereas if you hold physical alone, really you're probably going to end up needing quite a large allocation to deliver the sort of attribution characteristics that you're really looking for. So I think the opportunity is in the mining stocks, although we have around 20% of our portfolio in physical as well. So it's a combination of the two things.
Ned, thank you very much.
Not at all, my pleasure.
This is Emma Wall for Morningstar. Thank you for watching.